Hi, okay, this time we go to next chapter. It is the national income equilibrium. To determine national income equilibrium, we will use two approaches. The first one, called aggregate expenditure, aggregate supply approach. By using this approach, AE must be equal AS, meaning aggregate expenditure must be equal to aggregate supply. Second approach is leakage injection approach, meaning the amount of leakage in the economy must be equal or same as the amount for injection. Now we go to consumption and saving theory. So, for consumption, we have APC and also MPC. APC means a ratio of total consumption to total income. So, the equation is APC equals total consumption we divide with total income. MPC means ratio of change in total consumption to changes in total income. Okay, so the equation is MPC equal change in total consumption divided with change in total income. For saving theory, we have APS and also MPS. APS is ratio of total saving to total income. The equation is APS equal total savings divided with total income. And for MPS, it is ratio of change in total savings to change in total income. The equation is MPS equal change in total savings divided with change in total income. So, by using a formula, APC plus APS must be equal 1. Same with MPC. When we plus with MPS, also must be equal to 1. So, the function for consumption is C equal A plus BYD, while the function for saving is S equal negative A plus 1 subtract with B, then the amount we multiply with YD. Okay, so where to get A? A is the amount of C at the vertical axis. What is B? B is MPC, meaning in the function of S, we have 1 subtract with B. Okay, by looking at the equation MPC plus MPS equal 1, so 1 subtract with B in saving functions means the amount of MPS. Okay, so how to get income? We can get the amount of income by adding consumption with saving. Now we go to investment theory. We have two types of investment. It is autonomous investment and also induced investment. Autonomous investment is fixed and independent of income. So we have a perfectly elastic curve for autonomous investment, meaning for every amount of income, the amount of investment is fixed. It did not change. For induced investment, it depends on the national income, meaning the higher the income, will increase investment also. Factors influencing investment. We have 5 factors. The first one is rate of investment. So, if the rate of investment is high, the cost of borrowing become more expensive, and thus the investment from a firm will be lower, and vice versa. Okay, so there is an inverse relationship between rate of interest and investment. The second is rate of return. Okay, if the cost of investment is greater than the rate of return, this investment is regarded as not profitable, and therefore it will discourage investors and vice versa. So, meaning a higher rate of return will boost investments. The third factor is government policy. So, there are various government policies to attract investors, both domestic and foreign. The government gives some tax assumptions or reduction on investment. Okay, for example, in Malaysia, the government reduced corporate tax to encourage foreign direct investment. Okay, so number 4, we have technological changes. So technological changes can improve the quality of the product and also reduce the cost of production, which would result in a higher rate of return on the investment. So this would encourage more investors to invest. The last one is expectation of the future. So, future expectations depend on business forecast and economic condition. If the firm is confident or optimistic about the future profitability of new and existing products, they will be more interested to invest, and vice versa. Now, we go to government sector, G. So we have 2 categories of government spending. The first one, purchase of goods and services. The second is transfer payment. Foreign sector, X, export, and M, import. Export will increase the national income. It is an injection into the spending stream, while import will reduce the national income, as an import is a leakage from the spending stream. So, for national income equilibrium, we have 3 types of sector economy. 2 sector economy, we have households and firms. We also, the second type, we have 3 sectors economy. So in 3 sectors economy, we have households, firms, and government. Okay. For 3 sector economy, the third sector economy, we have 4 sector economy. So we have households, we have firms, we have government, and this is what we call as foreign sector, meaning export and import. Okay, so by using A, D, A, ADAS approach, okay, aggregate demand, aggregate supply, or some would say aggregate expenditure, aggregate supply approach. For two-sector economy, we need to add C and I in order to get Y. Okay, Y equals C plus I, consumption plus investment, because household will make consumption, firms will make investment. Okay, for three-sector economy, we have household, firms, and government. So how to get ADAS approach? In order to get Y, we need to plus household make C, consumption. Firm make I, investment. Government will make G, government expenditure. Okay, so we know for fourth sector economy, we need to add another one. It's foreign sector, export and import. So we have household, firms, government, and foreign sector. We have C, we have I, we have G. For foreign sector, in order to get the amount of national income, we need to subtract export with import. So C plus I plus G plus X minus M. Okay, that's by using ADAS approach. So leakage injection approach, the amount in two-sector economy, okay, the amount of I must be equal to S. Okay, household make saving, firm make investment. So the amount of S must be equal to I. Okay, in three-sector economy, I plus T must equal S plus T. What is T? T is tax. Okay, meaning investment plus government expenditure must be equal saving plus tax. Okay, for four-sector economy, I plus G plus X must be equal S plus T plus M, meaning investment plus government expenditure plus export must be equal to saving plus tax plus import. Okay, so for multiplier, one sector economy, we only have investment as our multiplier. For three sector economy, we have multiplier for investment, tax, government expenditure, and also balance budget. While for sector economy, it will become much more larger. Okay, we have I, we have T, we have G. Okay, we also have X, M, and also balance budget. Now, we go to graphical analysis for two-sector economy. Okay, the upper diagram shows ADAS approaches, while the lower diagram, the bottom diagram, shows the leakage injection approaches. Okay, so we look at ADAS approach first, meaning the upper diagram. Okay, so now we have the curve, a linear line for C equal 100 plus 0.7 C. So remember back at C function, A is 100 plus 0.7. 0.7 means MPC. Okay? The I investment is 500. Okay, so when we have I, meaning for two-sector economy, we must plus T plus I, isn't it? So at the vertical axis, okay, still looking at C line, Okay, C line start with 100. I line start with 500, meaning for Y, the amount of AD at Y0, okay, meaning the amount of C plus I at the vertical axis is 500 plus 100. It must be start at 600. Okay. So where is Y equals C plus I? It's on a black point there. Okay. Meaning by looking at this diagram, we know this two-sector economy got its equilibrium at Y is 2000. Okay. Next, for three-sector economy. So we look the C is become 3 line. Okay. The lowest is C equal 175 plus 0.75 Y. Okay, it's after tax, meaning after government imposed tax. C equal 200 plus 0.775 Y is before tax. It's 200. Okay. 200 is the consumption autonomous with a two-sector economy. Okay. With a three-sector economy, we must subtract with the amount of tax. Why? Because tax will reduce consumption. Tax is a kind of burden for consumer, so it will reduce consumption. That's why C from 200 after tax it become 175. Okay. So by looking at this diagram, this three-sector economy views the equilibrium is Y equal 1100. For first sector economy, meaning the line, the curve for C will be higher. Okay, it now become the consumption autonomous now become 325. Okay, so this first sector economy we need to calculate Y equal AD, meaning Y equals C plus I plus D plus X minus M. In the end, when we calculate that equation, we will get Y equal 1300. Now we go to multiplier concept. Okay. So the basic calculation is K equal change in income divide with a change in aggregate demand. Okay, so K equal 1 divide 1 minus MPC, or K equal 1 divide with MPS. Okay, so we get a amount of multiplier, meaning when there is a change in either one concept, okay, either it's investment, government expenditure, or tax. Okay, we want to look how many yes, the national income also will change. Okay, so when uh G, let's say the example is G, government expenditure. When there is change in government expenditure, meaning Y also will change. Okay, so it will multiply how many times? If you calculate multiplier equal to 4, meaning the Y will increase 4 times. Okay, So I will show how to calculate multiplier in our next video. Basically, we introduce you with the equation first. Now, investment multiplier. So, the equation is change in income divided by change in investment, because this is investment multiplier. For government multiplier, yes, we divide change in income with something. What is it? What is it? It is change in government expenditure. Okay. Tax multiplier, same thing. We divide change in income, but right now we divide with change in tax. Okay. So that's all for this time. Okay. See you again on our next topic.